And since the biggest pool of assets are basically in the most toxic waste imaginable, which is the derivatives market, once that starts to unravel, there'll be a move down the pyramid that will be quite substantial.
This video is brought to you by Reluctant Preppers. Click here to subscribe for free to reluctantpreppers.com.
There'll be a move down the pyramid that will be quite substantial. And again, I would urge you to, look at my article. It's kind of a briefing on it. If you want to get more in depth, you can type the extra pyramid into a good search engine. I'm sure there's plenty of articles out there that probably do a better job. Again, I'd direct you to Run the Gold by Trace Mayer. He did a great job of talking about it himself. I haven't read his article in a while, but he actually, in fact, I think he has a book or booklet about it, if I remember correctly. So apologize a little bit for being long-winded, but again, I'm a deep thinker and I like to think these things through and I like to explain them well. I don't like to leave people wondering why. I like to try to fill in as many of the blanks as I possibly can. And of course, being a little older than a lot of my peers now and living through one market, I try not to get too low when these markets are low or too high when these markets are high, because I've been there at a younger age and, it's very emotional. I try to keep my emotions in check. I mean, am I upset that silver is at 17? And the answer is no, I'm really not upset. I don't like it and it's irritating, but I'm certainly not emotionally involved like I would be in the last market where, I just lived and died almost with every move up and down. This time, no, I'm writing it out. It's an opportunity, as we talked about. If you have the cash to get in, buy for cash here. I think you're going to do quite well looking out a few years.
And for those who might be thinking that, maybe the precious metal bull market is over, you've talked about that it really isn't likely that the precious metal bull market is over because there hasn't been a public blow off top, as you've said. Did you want to talk about that?
Sure. There's, I've been involved in financial markets for a very long time. And when I was about your age, I was in the Los Angeles area. I think it was KHY TV. It was a TV channel that wasn't one of the main ones. And back in those days, there were only 20 stations or 15, even in Los Angeles, believe it or not. And this was a financial channel. In fact, this is where I got acquainted with Frank Barbera. For those that know the name, Frank and I have been friends for years and very good intellect. I really like Frank and his thinking. And there were all kinds of ads for financial products. One of the ones that was really interesting is a guy that, and I forget his name, I want to give him credit, but I can't recall. But he talked about the three phases of a market. And there's basically 3 up legs and 2 down legs. And this goes right back to the Elliott wave theory. And I'm not a big Elliott guy, but I do understand the basics of it. And, depending on how you look at the chart, and I know there's a lot of people that hate charts, but, I'm a believer that it has use. We've only had a couple phases, and we haven't had the big panic manic phase. I mean, if the gold bull market did run its course, it was a pretty weak run, because there was so little behind it relative to one, public participation, news media coverage relative to the problems that are global. I mean, what I like to do is compare the fundamentals first. The fundamentals are that in the 1980 market, there was a little bit of pressure on the oil markets, and there was an inflation problem in the United States, and gold shot up substantially and silver did even better. And it was all based on the M1 money supply, how much printing was going on. These days, everyone pretty much ignores that, and they're diverted into other markets. And there are a lot more markets to invest in now than there were back then. I mean, they've diluted it. They, meaning the financial system, has diluted the ability for money to go into gold, because it's like going to a county fair and there may be, 6 rides that you can spend your money on, but now you go in there and there's 600 rides that you can spend your money on, because you have all these derivative products, these ETF products, and all kinds of things, not to mention that the amount of stocks are greater. But primarily there's a lot of these derivative products that, are vying for your quote unquote investment dollars. Coming back on point, the big move up usually ends with an unbelievable amount of mainstream press coverage, with the public really jumping in. And the public pretty much has shied away from the precious metals for the most part all the way up. I mean, you got to remember, gold was up, I think, 12 years in a row. It was only in the 12th or 13th year where it fell off, which was 2013. But between roughly 2000 and 2012, if you were in the gold market, you made money every year, year over year. That's a pretty good track record. And then it was off one year and everyone was kind of, down in the mouth and unhappy, and thought, well, it's going to restart. And of course 2014 thus far has been pretty detrimental to gold, and of course silver as well, much more so in percentage terms. And so now some of those people that may have gotten in early, like in 2000, 2003, 2005, 2007, whatever, and they're looking at gold now, are thinking, this is it. Bull market's function is to shake off as many bulls as possible, and certainly this one has shaken off very, very many people that were gold and silver believers. So once the last are shaken off, and this is more of a metaphor than a reality, although there is some real merit to what I'm saying, then we can start back up. And people won't believe that this third leg is happening until it happens. And what kind of a crazy statement is that? And that means that you won't really see believers, people that really follow these markets, think that anything's really going on until gold makes it into the 2000 level, takes out the $1,900 level. And once that happens, you will see the momentum players come in. You'll see these fund managers come back in. You'll see these ETF players. In fact, they'll probably start resurrecting different ETFs that have more leverage to gold than ones that are out there right now. Who knows? I'm just, talking, thoughtfully, but sort of off the top of my head. But that's what it'll take. And, how long it'll take to get there from here, I don't know. What I do know is that once the momentum starts, it starts to build on itself. We've already seen that in the silver market and the gold market, primarily in the silver market. I mean, when silver made the breakout from 19, I actually had that on my website for our members and said, I'm going long at the break if it breaks above 19, and it did. And it went to 26. It started to flutter around, and I got out. And a $7 move per contract is a pretty nice payday. And then I noticed it was breaking up through 26, so I got back in, and that was on the QE2 announcement. And silver ran from 26 up to 48. And then we had QE3 and 4 and everything else, and people said, why did silver do what it did? The answer is that nothing performs better in an inflationary environment than silver. And the anticipation of the announcement of QE2 is there would be all this inflation in the system. And it didn't happen. All the inflation went into liquefying the bank's balance sheet, and it didn't go out in the public to be spent at all, basically. And so that money is basically dead money. I mean, it's just sitting, like, as a metaphor, it's sitting in a vault collecting dust. It's not doing anything other than making the bank happy, because their cash balance sheet looks a lot better, because when they were negative and didn't have cash to cover, they were insolvent, and they got this big injection. So that was a big market lesson for everyone, that, the inflation could be there, and it is. I mean, as an Austrian, an increase in the money supply by definition is inflationary. But yet the inflation itself didn't go to where people could see it. So for the public this time to get into that panic, manic buying phase that we're talking about, it won't be because wages are, moving up like it was in the 70s or everyone sees inflation. It'll be more of a loss of confidence. And in a way, it'll be much more damaging than it was in the late 70s, early 1980, because at that time, there still was the ability to bring interest rates up, just completely clobber inflationary expectations and move back to the dollar system and have it go forward. This time, the loss of confidence will be global. It probably won't be within the United States, and it probably won't be due to inflationary pressure. It'll be due to the debt markets and derivatives markets having a problem for settlement, or perhaps it could happen after the BRICS continue on their path to circumvent the dollar or extricate themselves from the dollar or the dollar trading system and have their own clearing systems in. But whatever it is, it'll be because people want out of the dollar. And it won't be, again, as for emphasis, it won't be just the U.S., it won't be the population of the United States of America saying, and they'll be part of it. But it could start anywhere in the world. And I think Jim Rickards probably does as good a job as anyone talking about, the death of money in the currency wars, because that's what it is. And that's how it's going to manifest. It's not going to manifest, I think, at the public level. The public will be the last. Once some of the bigger banks or bigger entities start to move out of the dollar in size and basically give up on it and move into something else, the tail will be the public, and they'll be running to, do whatever they can to protect themselves. So, it's not a pretty picture, but you have to look at the fundamentals. It's fundamentally impossible for the financial markets or the currency markets to continue to grow when the underlying physical economy doesn't match that. And that's the problem. The amount of debt relative to the physical economy, because they're basically supposed to match. The financial markets really are supposed to be reflective of what the true physical economy is. And price discovery is also supposed to be reflective of what the true price structure is. The price discovery method isn't supposed to be a discovery of how many derivatives have been written against a certain commodity and discover what the price of that derivative is, but that's what the market is. So that's what I mean by a large speculative casino. These bets that are going on in the markets, and I mean all the markets, aren't about, gold and silver per se, although, they're basically about what this derivative exposure is relative to that derivative exposure, because that's where all the money's being bet. It's bet on these paper derivative products. It's not bet in the physical market. That's why these physical markets can overtake the derivatives markets at some point, and I believe strongly that they will. The problem is that, and I get asked this, so I'll just answer my own question, is, well, why doesn't somebody just come in and make a big purchase? And the answer is that no one really wants to be the one that brings it down, that could bring it down. For example, a large nation state like China. Why doesn't China just buy all this gold and stand for delivery in December and take the markets out? Well, because they have a lot more vested interest in the paper markets than they ever do in the gold market, and they're going to continue to buy gold until they can't. And the only way to do that is to accumulate. And the way to accumulate is by a relatively small amount over a long period of time until there isn't any gold available. I mean, this is what happened in 1971 when Nixon closed the gold window. I mean, it isn't like in 71, all of a sudden one day, someone made a huge order and the next day you had to close the gold window. No, France and other nations were collecting gold, month after month, year after year, and it drained the gold pool. And all of a sudden, the reality was there over time. And they just chose August 15, 1971 to admit that there was far more dollars printed than there were gold to back it. Well, take that on steroids. Take that up to 100 times the amount of gold paper claims that there are relative to the amount of physical gold that there is. And that's the situation we are in. But it isn't like a nation state like France could come in and say, I want all this gold. I mean, it could happen. And again, the China analogy is a correct one. I mean, could they buy futures and stand for delivery? Sure, they could. But that's not the way it's going to take place in my view. I think they're going to continue to accumulate until they can't. And their gold position is like anyone else's gold position that understands these markets. It's for the day that the dollar collapses, or the month or the weeks. And usually these things aren't overnight. I mean, the dollar's been collapsing since 1913, like I outlined. The problem is no one wants an anomaly. In other words, a bank run, a bank closure, derivatives exposure, the stock market folding down, some electronic failures, some non-clearing, something that takes place that's so substantial and significant, primarily in the bond market would be my guess, or derivatives around the bond market or interest rates, that once that happens, you really can't put it back together. And we really got close. And we've been close a couple times. We were close with long-term capital management. Look at the movie called $1 Trillion Bet and see how close we were with that system almost coming unraveled due to long-term capital management. And we got very close, I believe, in the 2008 or 2007 crisis, where basically banks didn't trust each other. And believe me, this whole thing is a con game. It is a confidence game. And right now there's a lot of confidence in the dollar, but at some point in the future, that confidence could be displaced, and the confidence moves into an asset class that stood the test of time for thousands of years, and that's the precious metals. And there's so little relative to how much there is in every other asset class. If you look at that pyramid, you get a feel for all of that quote unquote money or claims on money versus how much money, meaning gold and silver, there is. And it's rather almost amusing to consider what it actually is, because it's significantly, in paper terms, basically off the charts.
All right. Well, David Morgan, we'll have to leave it with that. But once again, thank you so much for sharing your insights today. Did you want to share with the viewers where they can find you?
Sure. The YouTube channel is Silver Guru. The Twitter feed is @SilverGuru22. The website is silver-investor.com, and get on our free weekend mailing list if you want to see how we write and our thinking. And then for members, just go over the right-hand side. There's 3 levels of membership. If you have the most popular service, which is the intermediate one, you have the ability to actually write me an email directly. I don't necessarily answer them all. Sometimes I pass them off to one of my staff, but you always get an answer. And sometimes we put the answer, sometimes we put the answer in the report because we feel that the question is so significant that it'll benefit all of our readers. A lot of the times we'll just answer an individual directly because it's a question that basically has merit for them and them only. So that's something to bear in mind. Also, it's a 30-day money-back guarantee. I mean, if you subscribe to it and you don't really like it, just let us know, and you're done. You can stop. It's not a big deal. So thank you for that, Elijah. I hopefully gave your listeners something to think about. Certainly, I think about these things all the time, and I'll just end with this. I'm probably more concerned about where we are in the system now than I was, let's say, at the 2008 level before the crisis. I'm not predicting that this is going to happen, in any imminent way or time frame. What I'm suggesting is that the precursor to the situation financially prior to the 2008 crisis is worse today than it was at that time, and that concerns me.
This video was brought to you by ReluctantPreppers.com. Click here to watch part 2 of Reluctant Prepper's latest interview with Bill Murphy, where Bill Murphy explains why manipulation of the gold and silver markets have caused their prices to decouple from their fundamentals, and why now is a historic opportunity to get started and increase holdings of gold and silver. And finally, where you can get solid, trustworthy information on precious metals. Click here to subscribe for free to FinanceAndLiberty.com and also our sponsor, ReluctantPreppers.com, helping you be aware and prepared.